The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box. I'm Steve Sedgwick with Carolyn Roth, and these are your headlines. Standard Chartered announces a $1.5 billion buyback after missing bottom line expectations in the fourth quarter. We're going to speak with the lender's CEO, Bill Winters, just ahead. The US reportedly resists labeling Russia an aggressor in a key communiqué following a testy week between President Trump and Ukrainian leader Volodomyr Zelenskyy. The former Ukrainian Foreign Minister Dmytro Kuleba tells me Trump only considers one thing.
I believe he doesn't care. I believe he does not care about any single country in the world except the United States.
Alibaba shares surge as the Chinese tech giant pledges aggressive investments in AI and posts its fastest revenue growth in a year. Germany's election campaign enters its final sprint with transatlantic ties dominating discussions. Frontrunner Friedrich Merz says Europe's future hangs in the balance.
Das ist nicht mehr das Amerika, das ich mag.
This is not the America I used to know 40 years ago. Something is changing at the moment, and we may only really understand how profound these changes will be in a few years' time.
Standard Chartered posted fourth quarter net profit of $493 million. That's a bit below forecast, with operating expenses and restructuring costs coming in higher than analysts had expected. The Asian-focused lender announced a $1.5 billion buyback and said it plans to increase shareholder distributions over time. Well, we're privileged to see Bill Winters, CEO of Standard Chartered, has joined Caro and myself around the desk. Nice to see you, Bill.
Very nice to meet you.
Do you want to just address that line that my team have picked up, that the number was slightly below forecast in the fourth quarter?
Actually, almost all of our numbers were better than forecast, and all the important ones. So our underlying profits are up 21% year on year. Our income is at record levels, highest of all time. The shareholder distribution at $1.5 billion is far exceeding the market expectations. Why is all that happening? Because we've got a really clear strategy. It's been working for a few years now. I'll say it's been working for many years, but it's been clear in terms of earnings for a few years. We've got tremendous momentum. We're picking up market share in all of our key areas. Very focused strategy, focus on our cross-border business and serving our affluent clients across Asia, Middle East, and Africa. And every single one of those pistons is firing. So we couldn't be happier with the quarter.
Okay, great. And I want to dig into the numbers, as does Karen, in a few moments' time. But let me just ask you about a buyback. 1.5 billion buyback. You've got a share price which has rallied since late 2020 from 336p to 1140 pence on the London listing as well. What's the point of a buyback at this level?
We're still cheap. To put it very straightforwardly, we've got a ton of potential in this company. The markets that we serve are growing fast. Our positioning in those markets is good and getting stronger. Of course, the share price has improved. We think we can drive it much higher.
But why not just do that via running the business the way you've been running? And you know, as I'll just go through some of those numbers again. Global markets up 15%, global banking up 15%, wealth solutions, which is a real standout, up 29%. Why do you need to use your capital buying back shares? Is that what the investors say? Because I'm really always fascinated in that conversation. Why don't we just carry on the business, allocating capital efficiently where it can be best used, rather than buying back shares?
Yeah. Well, the first thing we do is invest in our business. So we invested about $2 billion in our business last year. We've been investing consistently for the past 10 years, I'll say, which is my time in the bank. And we will continue to always invest in the business first. Once we have tapped out the opportunity that we see in the short term, keeping in mind that we don't want to throw money at problems or situations or opportunities. We want to invest cautiously and appropriately. What's left, we return to shareholders. Yeah. Thankfully, we've been generating substantial surplus capital. And our expectation is that we'll continue to generate.
And just final one on that one. Why would you prefer to do that rather than up the divvy significantly? Because, I mean, historically, I've looked at bank divvies and, you know, a solid bank divvy comes in at 4-5%. When the bank's in trouble, it comes up at about a 7-8, like Lloyd's in 2008. You're at 2%. What about upping the divvy if you're so confident in the future?
So we have increased the dividend substantially. It's up 37% year on year. And we look very carefully at what our shareholders want. Of course, some shareholders prefer a dividend. Yeah. Some shareholders don't prefer a dividend. They'd much rather have us return capital by buybacks. We think we've got the right mix.
Fair enough.
Bill, if we can show the UK listing of your stock, Steve mentioned the share price before, 11.40, and you must be popping champagne bottles right now because it is finally back above the price when you came in as CEO, and the stock has been trading below that. You say you're still undervalued. It's been trading below book value. What do you think investors haven't been seeing throughout the last decade?
Well, first thing is I broke cover on the bank's strategy with a share price of about £4. So to go from 4 to 11, you're right. That's good. But this doesn't reflect the complete value of the company in our estimation. Of course, the market's the market, and we respect it completely. I think it was hard to understand Standard Chartered Bank. We were in lots of lines of business and lots of geographies. Things happen in those different markets. I think we've articulated over the past several years a very clear strategy. What we are is a bank that serves cross-border needs of corporates, financial institutions, and other global investors, and serves affluent individuals in Asia, Middle East, and Africa. That's it. It's quite straightforward. There's some interesting data in our earnings deck available online, which gives an indication of how we serve the different trade corridors in the world. Extremely diversified between Asia, Middle East, Africa, US, and Europe, with only 7 markets generating more than $100 million of income. So we've got a really good diversified cross-border business. Cash management, trade, financial markets, global banking, and then, of course, serving affluent clients with a best-in-class wealth management product.
A final one on the share price. You've called it crap in the past. What would you call it right now?
Less
crap. Than before.
No. Look, our share price is what our share price is. We're looking at from what we can see, what we've told the market, we're going to continue to grow our income. We're going to continue to grow our profits ad infinitum because we're in the right markets and we've got a strong position. So if we execute as we have, our share price will go up.
Right. You call the business well diversified, yet targeted and very specified. If reports are correct, you were recently in India, one of the biggest wealth markets in the world. How do you grow in that increasingly profitable market? Is it through local partnerships? Do you buy a business, a wealth management business there? Do you do it alone? How do you do it?
So we've got a best-in-class wealth management business in India already. We've been there for a very long time. But you're right, it's taking off. So you've got a huge emerging middle class that are saving for the first time typically in their families' histories. Of course, there's always been a cadre of relatively wealthy people who are growing and becoming more wealthy. We invest in technology and we invest in relationship managers. It's the same prescription everywhere, although it's quite different from market to market. So we've got certainly from the survey perspective, we've got a leading market share position. Customers say that we're their preferred choice for doing business. We just need to keep on delivering to those customers.
I want to tie in Jose's statement, and who you've said some lovely words about, because of course he is stepping down. And your statement as well. So you're talking about, again, I'm piling through the 67 pages, can't do it all in these minutes, but Asia, Africa, Middle East, great sustainable growth for you there. But Jose's made some very interesting comments, and he says the world is in a period of transition from a Western-led and progressively more integrated global economy to an era of multi-alignment. There's a lot more in there as well, but I think that is absolutely fascinating. Maybe I'm going down the wrong road on this one, but it says to me that the West, designing the architecture of the global financial system, its days are numbered. Am I going down the wrong route on this?
No. Well, I mean, there clearly some things have changed. Thankfully, some things will be the same. So we've seen the relevance, for example, of the IMF over the past 3 years when we've had a series of debt challenges or liquidity challenges in many emerging markets. The IMF continues to be the force for good that comes in, stabilizes, puts a plan in place, gives some political air cover to the local governments that have to implement quite challenging plans at times. And that's part of you call it the Western-led order, but of course it's a global institution. But in other cases, we see that whether it's the nature of global trade or the regulation of global health, those institutions have weakened, and we have to accommodate for that.
Is Donald Trump exacerbating that trend?
Well, Donald Trump is clearly part of the fragmentation of the global system broadly. Some would say it's just a repositioning of the power bases in the global system, but it's definitely a bunch of change. And thankfully, change typically generates opportunities. It also generates risks, and we're seeing both right now.
And China is a great example of the opportunity and the risk encapsulated in one enormous power center as well.
Yeah.
How do you read China at the moment? I've spent a lot of time this year pouring into whether we are seeing a recovery, whether the consumer is recovering in some areas but not in other areas. How do you see China and its leadership in some of those markets you're looking at?
China has been going through one of the great transitions. We call it from old economy to new economy over the past several years. It's been accompanied by a serious property crisis, which is stabilized but hasn't yet significantly improved. Certainly there are stimulus actions that are happening that should, I think, get that market at least moving again. The consumer's been very reluctant to spend, and businesses have been reluctant to invest, both domestic and international. You're seeing the charm offensive. You're seeing the president meeting with the private sector. Yeah. Serious private sector reforms, serious step up in stabilization measures. Has been a significant refinancing of the troublesome local debts at the provincial and municipal level. So these are all part of the program of getting China going again. Let's remember, China grew 5% last year. It's probably going to go 5% this year. This is not a calamity at all. China is still the largest exporter in the world, and exports are growing. So overall, I'm very optimistic about China. I might add Hong Kong as part of China and one of our key home markets. They've both been through a tough time. It feels like they're coming out of it now.
Bill, before we let you go, how much do you think about your own future? Your chairman is leaving very soon. You've been the longest serving UK bank CEO. Are you the British or the UK Jamie Dimon, who's simply indispensable to the company, to the banking sector?
Yeah. I would love to be Jamie Dimon, right? I'd love to have that track record. We don't have it yet. It would be great to finish my time at Standard Chartered with the kind of track record that JP Morgan has achieved. But look, I'm completely focused on delivering the plan that we've got right now, and there's no distraction there.
Mm-hmm. Do you have a succession plan in place?
We've got fantastic successors inside Standard Chartered, and my objective from day one has been to be able to say to the board at the right time, you've got a choice. So horses for courses. You pick the one that you want, but I want a plethora of exceptional talent at the top of our bank, and I think we've got that today.
Make it competitive to see who succeeds you, Bill. Lovely to see you. We have to let you go.
Thank you for having us.
Thank you very much indeed for joining us. Always a pleasure. Hold on for 2 seconds. Bill Winters, CEO of Standard Chartered.
Let's take a check of U.S. markets yesterday. We did see some losses across the board. The Dow bearing the brunt of the losses, down by roughly 1%. We also saw the S&P 500 down by 0.4%. The Nasdaq also showing some slight losses here. A couple of factors here, probably some profit taking in there. The S&P is still close to its recent record highs, but Walmart dropped on disappointing sales forecasts. We'll talk about this in just a second. Treasuries, yields trending a little bit lower. The 10-year Treasury yield at 4.488%, back below that 4.5 level. We also had some reassuring comments from the new Treasury Secretary Bassett. No near-term plans to change debt levels. Let's take a quick check of the dollar as well. The dollar currently is just a little bit higher against the euro, sitting at 104.91. When it comes to the yen, back above that 150 level, fell below that threshold in yesterday's trading session. Quick check of gold prices as well. They're on track for their 6th weekly gain. There you go. Currently a touch lower by 0.3%, 29.29. Asian markets, last time I checked, they were on a tear. Well, they still are. The Shanghai Comp up by 0.6%. Obviously getting a shot in the arm from the numbers from Alibaba. We'll talk about those in just a second as well. The Nikkei 2 to 5 reversing some of the previous losses from this week, up by 0.3%. European opening calls look like this. A bit of a mixed picture. The FTSE MIB seen up by 22 points. The DAX seen up by 27 as we head into the elections.
What's the most important company in America?
Oh, Walmart. Obviously, it's the consumer. It's all about the consumer.
I'm glad you say that, because I think a lot of people straight away go to Google and Apple and Amazon and Nvidia as well.
It's the best reflection of the consumer and their inflation expectations.
Oh my God, this is so bad because we're totally agreeing.
That's
normally Karen would completely disagree with me about something, but I agree with you, Caro. I think Walmart is the greatest barometer of the US consumer, and the US consumer represents circa 70% of the US economy. So when Walmart shares post their biggest one-day drop since 2023, then we have to pay attention. Now look, let's be honest, look at those shares. They have rallied dramatically over the last year. So no one's saying the US consumer is going to drop off a cliff. In fact, I'm saying nothing of the sort. But they have guided for slower profit growth this fiscal year. Now, speaking to this very channel, the CFO, John David Rainey, said that consumer patterns are steady, but the geopolitical landscape is far from certain.
And the thing is, they didn't even incorporate in that forecast the impact of the trade war. So that is the big point of uncertainty here. It's really just about simply a lower sales forecast. But no one knows. Of course, not even Walmart executives, not even the consumers know what the impact will be of the trade war.
Do you know, US consumers, like the rest of us, don't know what a trade war means for their basket, but they do know with egg prices up 30-40% that things feel more expensive, even as we discussed previously. Actually, eggs are a small part of the broader CPI, but it's about confidence and It's about sentiment, and these are almost intangible at some stage.
And the Michigan index told you so much about these increased inflation expectations, and that spells trouble politically, doesn't it?
We have a bumper week of earnings next week. I hope we got through it, but no. A bumper week next week. Home Depot reports on Tuesday, whilst on Wednesday, look at that. See, that's the one that probably has, whereas I think Karen and I agree about Walmart. For the market, Nvidia probably is the hot number, isn't it, on Wednesday. Salesforce, AB InBev, and Stellantis also reporting. Tech-heavy Thursday. What have we got? HP and Dell.
And Alibaba shares are surging to their highest level in more than 3 years after the Chinese tech giant announced it will invest aggressively into AI in the years ahead. The company reported $10 billion in capital expenditure last year as it continued to buy processors and infrastructure to train large language models. Alibaba also beat analysts' expectations for its fourth quarter revenue, posting 8% growth, the fastest rate in over a year. Steve, what's coming up on the show?
I'll tell you what's coming up on the show, because it says here, coming up on the show, it's been a rough week for US-Ukraine relations, and we're going to get reaction from the former foreign minister, Dmytro Kuleba. Had a long interview with him yesterday. Plus, the final countdown is underway for the German election. Thank goodness, the longest snap election run-up in history, as the frontrunner Friedrich Merz warns transatlantic ties are hanging in the balance. And we're going to be speaking to the CEO of Leonardo, Roberto Cingolani. You've got to listen to that interview. He's a former minister as well, so he's got great insight as the defense and aerospace firm beats on its 2024 guidance. That's exclusive CNBC conversation coming up in 1 hour's time. The US Treasury Secretary Scott Bessent has suggested an easing of sanctions against Russia could be a possibility as part of talks to end the war in Ukraine. Bessent said the US was prepared to move economic measures in either direction based on the willingness of Russia to reach a deal. The US is reportedly objecting to the phrase Russian aggression in a statement by the G7 on the third anniversary of Moscow's full-scale invasion of Ukraine. This according to the Financial Times, citing Western officials. The reported opposition follows Trump suggesting Ukraine was responsible for the war, with the US president calling for Russia to be invited back into the group, formerly the G8. Well, this week has seen relations between Washington and Kyiv turn frosty, with Ukraine not invited to talks between top US and Russian officials in Riyadh on Tuesday to discuss ending the war. Ukrainian President Volodomyr Zelenskyy said his country would not accept any outcome of talks held behind Ukraine's back. European leaders were quick to reiterate calls for a seat at any negotiating table and the involvement of Ukraine in the peace process, with the French President Emmanuel Macron convening emergency talks in Paris to discuss the situation. As Ukraine called to be involved in negotiations to end the war, President Trump suggested they were responsible for starting it.
Today I heard, we weren't invited. Well, you've been there for 3 years. You should have ended it 3 years. You should have never started it. You could have made a deal. I could have made a deal for Ukraine that would have given them almost all of the land, everything, almost all of the land, and no people would have been killed, and no city would have been demolished, and not one dome would have been knocked down. But they chose not to do it that way.
Trump also expressed his disapproval of Zelenskyy's performance as Ukrainian leader, claiming his approval rating was only 4%. Zelenskyy responded with his own criticism, suggesting Mr. Trump was being unduly influenced by the Russian President Vladimir Putin, which then drew the ire back of the US president.
Since we're talking about 4%, we've seen this disinformation. We understand it's coming from Russia. Unfortunately, President Trump, with great respect for him as a leader of the people, which we respect very much, the Americans, who constantly support us, unfortunately, he lives in this disinformation space.
A dictator without elections. Zelenskyy better move fast or he's not going to have a country left. Got to move fast because that war is going in the wrong direction.
As Russia's full-scale invasion approaches the 3-year mark, I sat down with the former Ukrainian Foreign Minister Dmytro Kuleba, and we had a very long conversation. In that conversation, I asked him what he thinks is going on in the US mindset.
I don't think President Trump is sensitive to accusations of spreading Russian disinformation. I believe he is pretty firm in what he believes in, and I don't think it's going to work, just to tell him that you are wrong. Everything we know about him is that if he never recognizes his mistakes. And it will be an issue. The question is, he looked around, he thought, Europe is not a partner to make a deal. Ukraine will have to impose what I tell them to do. So the only side that I really have to make a deal with is Russia. And he's wrong in this assessment, because whatever kind of deal he may strike with Putin, there will be two issues. One, you cannot enforce a deal without Ukraine and Europe. And second, Putin does not trust Trump. For a very simple reason, because he does not know whether Trump's promises will hold after he's gone. And he does not need a temporary solution. He knows that the best guarantee for him that Ukraine will not become a member of NATO is the non-existence of Ukraine. In his conviction, the West always betrayed him. And unfortunately, there are some pundits in the West who kind of reinforce this message and tell the stories of how bad the West was and towards Russia, and how the West brought all of this on our heads, which is not true, but that's a different story. So there are some very, very big hurdles ahead of Trump.
Do you think Donald Trump cares what happens to Ukraine? He just wants a deal. He just wants to stop financing the war. Obviously, he's talked about a huge number, which has been disputed. But do you think he actually cares what happens to Ukraine? Do you think he cares about the ramifications for Europe and for the world?
I don't think he cares. Okay, let me put it even simpler. I believe he doesn't care. I believe he does not care about any single country in the world except the United States. The only what really makes him feel kind of concerned is that Ukraine does not turn into his Afghanistan. That Ukraine does not, his plan does not collapses in a way that will expose his weakness to the whole world, that he failed to achieve, because he has zero tolerance to failures. We know him, and this is the issue. So it's not about telling him how good Ukraine is and how it deserves his support. Doesn't make sense, because that's not how he thinks.
So I sat down with Dmytro Kuleba, who for a large part of the war was the ambassador at large, so to speak, the foreign secretary, touring the world, trying to drum up support. And we also addressed why the South, the global South, has been slow to support Ukraine as well. In fact, non-existent support in many cases as well, including China and less so India as well. But we talked a lot about the ramifications of a potential abandonment of Ukraine from its previous US support as well. And I think that what Mr. Trump has tried to frame this as, it's a European problem, it's a Ukrainian problem. This isn't something the US needs to worry about. He talked in the last 48 hours about a big ocean between us and Europe. We're safe. And I think the thing that perhaps a lot of commentators who know this situation have been pointing out is that actually what happens in Ukraine, what happens with the relationship between Mr. Putin and Mr. Trump, between US and Russia, actually has grave ramifications for the United States in many, many areas. Dmytro Kuleba firmly believes that if Putin were to gain control of Ukraine, or at least create a non-state out of Ukraine as well, then there are ramifications for the EU, there are ramifications for the Baltic nations. Who knows whether Putin would feel that he can actually be more aggressive against an EU state. But the point here is as well, if there is a combat situation or military solution from Putin towards an EU state as well, then that creates huge ramifications for the US, whether it likes it or not. Plus the fact the Chinese are watching how America deals in this situation. And if they feel emboldened because the West is weak, because liberal democracies are weak as well, that can have ramifications for the US and its Taiwan relationship as well.
Very pertinent points here, not just China, obviously, but also Iran. And that's why Macron is going over to Washington to warn Trump about this. We just want to take it back to the market perspective. What we've seen this week after shocking developments when it comes to the European perspective and the US support, which may not be forthcoming. Let's take a look at the defense stocks and what they've done week to date. Tal is up to 10%, BAE up by 5%, Rheinmetall also surging by 9%. This is on top the more than 20% gain that we've seen since Donald Trump has been elected. So they've been flying. You got to wonder to what extent they can do business efficiently, though, because there's no unified procurement market in Europe. We'll talk to Leonardo later on. But there's problems when it comes to staffing, and there's problems in terms of collaboration in Europe.
Yeah, I just want to say that we're going to run that full interview, and you can see it on YouTube, you can see it on Spotify from this coming Monday with Dmytro Kuleba. One thing I will say is we got into a whole lot of geopolitical issues, a whole lot of issues about the European Union, about NATO, about Ukraine itself. We also talked about the collective trauma towards the end of the interview that Ukraine is going through, and that there are kids growing up who don't remember a time when there wasn't war. And I know the Ukrainian people. I've been to the country quite a few times, and they are a strong, resilient people. But when Dmytro Kuleba says to me the whole country is going through a stunning trauma, quite frankly, I find that gobsmackingly sad as well, and just sad for those young people as well. Can you imagine if your own family were going through that?
Thank you for listening to Squawk Box Europe Express.
For more market-moving news, you can head to CNBC.com.
Or join us again on the show with Steve Sedgwick, Karen Cho, and myself, Arabile Kumete, weekdays on CNBC.